Hello everyone, welcome to the weekly lecture videos once again. And this is the last video of this chapter. And in this video, I'm going to talk about some pitfalls of the cost of capital. First of all, from our so far discussion, you may have understood that there are a wide variety of factors that affect a company's cost of capital. Um, some are external factors and some are internal factors. External factors, for example, interest rates, tax rates, market risk premium, those will in turn affect different components of the cost of capital, and so is the overall cost of capital. Similarly, firms' capital structure, that means a particular mix of the debt and equity, and dividend policy, how much dividend the company has historically been paid, and what is the expectation about future dividends. They also determine the cost of capital of a company. And an overall conclusion, as we have learned so far, is that firms with riskier projects generally have higher weighted average cost of capital because the investor will require a higher return to compensate their risk of the fund they have provided. So let's continue our discussion, divisional and project cost of capital. As we have seen, using the weighted average cost of capital or WACC as the discount rate for future cash flows is only appropriate when the proposed investment is similar to a firm's existing activities. This is not as restrictive as it sounds. For example, if we were in the retail electronics business selling TVs, DVD players, and so on, and we are thinking of opening a new location, then the weighted average cost of capital would be the discounted to use. The same would be true for a retailer thinking of opening a new store, a manufacturer thinking of expanding production, or a consumer products company thinking of expanding its markets. Nonetheless, despite the usefulness of WACC as a benchmark, there will clearly be situations where the cash flow under consideration have risks distinctly different from those of overall. Okay, now we consider how to cope up with this problem. So we need to consider risk-adjusted weighted average cost of capital. Now, when we are evaluating investment with risks that are substantially different from those of the overall firm, the use of the weighted average cost of capital will potentially lead to poor decisions. All right. If we remember the SML line where there is a certain risk-free rate and there is a market risk premium, to keep things simple, let's consider an all-equity company with a beta of 1. Okay, so weighted average cost of capital and the cost of equity for this project would be the same. Okay, because it has a beta of 1. Now, suppose our firm uses weighted average cost of capital to evaluate all investment. This means that any investment with a return greater than this certain return will be accepted. Let's say this is 15%, and any investment less than this will be rejected. Okay, we know from our study of risk and return, however, that a desirable investment is the one that plots above the SML. Okay. Now, if a project has a beta of 0.6 compared to firm's beta of 1, it will have an expected return of 14%. Okay, expected return of 14%, and its required rate of return is 11.8%. So the project should be accepted because its expected return is higher than its required return. However, if we use the WACC as a cutoff, then this project will be rejected because its return is less than 15%. Okay, this example illustrates that if firm uses its WACC as a cutoff across all projects, will tend to reject profitable projects with risk less than those of the overall firm. Okay, just to summarize that the firm's weighted average cost of capital was 15%, considering its beta of 1. But a special project that we talked about, it has a beta of 0.6. So it has a lower systematic risk than the overall farm. That's why its required rate of return is also lower. Okay, so the farm's overall required rate of return is 15%, but this project's required rate of return is 11.8%. That's why to evaluate this project, the farm's overall cost of capital should not be used. Okay, so once again, just to summarize, a project's cost of capital would be equal to the overall cost of capital of the farm if they are similarly risky. Okay, on the other hand, if a project is less risky than the overall riskiness of the farm, it should have a lower cost of capital. And if a project is more risky than the overall cost of capital of the farm, then it also should have a higher cost of capital. The same type of problem with the WACC can arise in a with more than one line of business. Okay, imagine, for example, a corporation has two divisions: a regulated telephone company and an electronics manufacturing operation. The first of these has relatively low risk, and second one has high risk. In this case, the firm's overall cost of capital really a mixture of two different cost of capital, one for each division. If the two divisions were competing for resources, then firm use a single WACC as a cutoff, which division would tend to be awarded greater funds. The answer is that riskier division would tend to have greater returns, so it would tend to be the winner. The less glamorous operation might have greater profit potential that would end up being ignored. Okay. So relatedly, let's talk about a pure play approach. We have seen that using the firm's weighted average cost of capital can lead to problems, right? How can we come up with an appropriate discount rate in such circumstances? Because we cannot observe the returns of this investment, there generally is no direct way to coming up with a beta, for example. Instead, we must do what we must do is to examine other investment outside the firm that are in the same risk class as the one we are considering and use the market required returns on those investments as the discount rate. Okay. So this approach is known as pure play approach. Okay. So what we try to do here is to find companies that focus as exclusively as possible on the type of project in which we are interested. Okay, and we use the beta of that company to be considered as the beta of the individual project. Okay, and then we do the rest of the calculation or rest of the estimation. So that is called pure play approach. Okay. For example, if we are thinking of entering a new line of business, we will try to develop the appropriate cost of capital by looking at a business which is in the same line of business. Okay, same line of business. That's why we call it pure play approach. If you wanted to bet on the price of crude oil by purchasing ordinary shares, you try to identify companies that deal exclusively with this product, since they would be the most affected by changes in the price of crude oil. Okay. We also can go for subjective approach because of the difficulties that exist in objectively establishing the discount rate for individual projects. Firms often adopt an approach that involves making subjective adjustment to the overall weighted average cost of capital. Okay. So to illustrate this, suppose a firm has an overall cost of capital is 14%. Okay, and it has several categories of projects. For example, new product, cost savings, replacement, pollution control. So what they will do is they will classify each of them on the basis of their risk. For example, new product is high risky, cost savings projects are more moderately risky, replacement projects are low risky, pollution control are mandatory. So they classify each of them as and once the projects are classified as high, moderate, or low risk, then the discount rate for each of the project is adjusted. So for example, let's say that weighted average cost of capital of firm is 14%, but for new product development, since it's high risky, it is added by 6%, so the discount rate will be 20%. And moderate risk doesn't require any adjustment. Low risk is adjusted down by 4%, so the discount rate is 10%, and so on. So the point that I'm trying to say here is in the subjective approach, firm has a weighted average cost of capital, and each project the firm is considering will be classified as high, moderate, low risky, and then their cost of capital will be adjusted to use an appropriate cost of capital for each of the project. Okay, so to conclude, it would be better in principle to determine the required return for each project objectively and separately. However, as a practical matter, it may not be possible to go much beyond subjective adjustment, either because the necessary information is unavailable or the cost and effort required are simply not worthwhile. Okay, so that's the end of our discussion in this video, and also this is the last video for this chapter. Okay, so if there is any question related to any of the topics we are covering here, don't hesitate to let me know. In the next video, I will start discussing chapter 13, and we will initiate our discussion on capital structure. Thank you very much.